Welcome students. Today we will be doing chapter 6, that is cash flow statements. Cash flow statement shows inflow and outflow of cash and cash equivalents. Now equivalent means near about cash. We will come in detail afterwards. Next, to gain an insight as to where the funds are coming from, that is the sources of cash, and where they are being applied, that is the use of cash. All source and use are classified under three types of activities. First, operating activities, which are related to day-to-day business of the enterprise. Next, investing activity, which are related to the assets, investment, sale and purchase. And the third activity is financing activity, that is related to money source and their redemption. Institute of Chartered Accountants of India has issued Accounting Standard 3 revised to deal with the format and other key issues of the cash flow statement. As you remember, it is also an important technique of financial analysis, as we had already told you in chapter number 4. What is the nature and need of cash flow? It shows inflow and outflow of cash under various activities, that is operating, investing and financing, and all the economic decisions are also taken by the users after evaluating the cash flows. Now, what are the benefits of cash flow? It gives us an information about an enterprise liquidity position and its ability to generate future cash flows. Next, it also provides information about the organization's ability to meet its obligation in time. Next, it also provides information about why there is a change in the assets or liability, that is whether they have been sold, purchased or what has happened. Next, it also helps in assessing likely future financing needs of the organization. And the last, it also enhances the comparability of operating performance of different enterprise by eliminating the effect of using different accounting treatments for some transactions and events. Now, first of all, let us understand some important terms which are going to be used in this chapter. The first very important term is cash and cash equivalent. First of all, it includes cash, bank, drafts in hand, bank overdraft, though it is a negative item, short term investment, marketable securities. Now, all these are readily convertible in cash and are subject to very insignificant risk, and they are always available, that is at short notice, for meeting any current commitments. Investment with very short maturity period, that is 3 months or less, are included in this category. A very interesting point is that if we acquire preference shares of another company with redemption date very fast approaching and there is a very insignificant risk of failure of the company, it can also be taken as cash equivalent, though generally we do not take investment in shares in cash equivalent, it is taken in investing activity. But if this is the case, that is a very fast maturity is approaching, then we can take it as cash equivalent. The next important term is cash flows. Any inflow and outflow of cash from non-cash items like sale or purchase of machinery, receipt of cash from debtors or payment to employee, etc., are all included in cash flows. All movements between cash and cash equivalents are not taken in the purchase of short term investment, deposit in bank, etc. Now, these are not taken because one cash is coming and the another cash is going. So, there is no actual inflow of cash or outflow of cash. The next activity is cash from operating activity. Now, what is an operating activity? It means the main activity of the business or principal revenue producing activity. Now, it is regarded as a key indicator to the extent of ability of an enterprise capability to generate sufficient cash flow for the enterprise various activities. In other words, we can say cash from operating activity means all those transactions related to the determination of net profit or loss. Let us understand operating activity with some examples, starting with example of cash inflow from operating activity, receipt from sale of goods and services, royalty, fees, commission, etc. received. Let us take some example of cash outflow also from operating activity, cash paid to suppliers for goods and services, cash paid to employees and all other operating expenses, income tax paid, but please remember relating to operating activity only, and the refund of income tax to be adjusted with income tax paid. There are some other important points. When we sell some asset, it can result in profit or loss. Now, this profit or loss will be adjusted in operating activity, but the amount received as sale proceeds will be adjusted in investing activity. Some enterprise deals in shares or debenture for trading purposes, that is investment company or banking company. Cash flow from the sale or purchase will be taken as operating activity for these enterprise, but otherwise for all other companies these transactions are a part of investing activity. Now, let us understand what do we mean by cash from investing activity. Investing activities are related to the purchase and sale of long term assets, investments, etc., and also include return on investment like dividend, interest, rent received. They are also included here. Let us start with some examples of inflow of cash: sale of asset, receipt of loans and advance given to third party, that is refund from them, and interest received on loans, and sale of investment also included here. Now, let us see some outflow examples. Suppose we are purchasing an asset or we are giving some loans and advances to third party. They are the examples of outflow of investing activity. Now, next point is what do we mean by cash from financing activity. Now, financing activity is related to the money part of the business, that is receipt and payment and all related activities relating to money inflow and money outflow for business. Let us take some examples. Examples of inflow are issue of shares, issue of debenture and taking of loans, and the example of outflow can be redemption of preference shares, debentures and interest paid as well as repayment of loans are the example of outflow of financing activity. There are some very important observations to be made. First, let us say when we are selling a fixed asset or purchasing a fixed asset on credit. To start with, purchasing a fixed asset on credit, and at the time of payment of the installment, the payment will include both principal as well as interest. Now, the loan part which is being paid will be dealt in investing activity and the interest part will be taken care of in the financing part of the activity. I think it is a very interesting point. Similarly, when we purchase share of other companies, it will be an operating activity for an investment and banking company, but it will be an investing activity for all other non-investment company. So, the same activity has two roles. Sounds interesting again. Now, let us start with what do we mean by extraordinary items. Extraordinary item means which are non-recurring, so they are disclosed separately. We can take some examples like claim, damages, compensations. They do not often happen daily. They should be disclosed separately so that the user can understand its effect on the present and future cash flows. Next point, tax on income and gains. If the tax is paid on income, it is an operating activity, and if the tax is paid like dividend tax, it is a financing activity, and if the tax is related to capital gain part, that is on the sale of asset, it will be treated in investing activity. But if nothing is mentioned in the question, we always take it as operating activity. Now, let us understand what are non-cash transactions. Transactions which do not result in inflow or outflow are not considered here. We can take some examples like shares issued for consideration other than cash. Now, there is no inflow of cash, no outflow of cash. So, this will not be considered, and if both the activities are part of cash and cash equivalent like sale of short term investment, they will also not be considered, because there is no inflow of cash, there is no outflow of cash. So, these transactions are excluded from cash flow statement. There are two ways of presenting the cash flow statements as prescribed by AS3 revised issued by ICAI: indirect method and direct method. The most popular is indirect method. So, let us start with the format of indirect method. The first activity is cash from operating activity, in which we start with net profit before tax. So, if you are given net profit after tax, first you have to add back tax, then you will reach at net profit before tax, and then you have to add non-cash non-operating expenses, because we are trying to calculate cash from operating activity. So, whatever non-cash and non-operating expenses are already taken in P&L account, they have to be added back, like depreciation, loss on sale of asset, interest paid. Now, interest paid is being added because it is a non-operating activity, provision for bad debts, and all other non-cash non-operating expenses to be added. We will come in detail in the questions. Then we have to subtract all those non-cash and non-operating incomes also, which are not related to the business part and which are not cash, like interest, dividend, rent received, and the gain on sale of asset. Now, gain on sale of asset is a non-cash activity and non-operating also, because selling the assets is not our business. Now, what you get is cash from operating activity before working capital change, extraordinary item and taxes. Now, this say कि you have to now do working capital change, extraordinary item and tax. So, these three steps will follow to calculate cash from operating activity. So, let us start with working capital change. Now, what to be added, what to be subtracted? If the money is flowing in, it will be added, and if the money is flowing out, it will be subtracted. Like decrease in current asset will be added and increase in current liability will be added. Why? Because when current asset decrease, that means cash is coming and the asset is going. Take an example, received from debtors, cash is coming and debtor is going. So, it will be added. Similarly, decrease in current liability to be subtracted and increase in current asset will also be subtracted. Now, here we reach cash flow from operating activity before extraordinary item and taxes. So, the next step will be extraordinary item of income will be added and extraordinary item of expenses will be subtracted. So, we reach cash from operating activity before tax, and then we have to subtract tax paid by the company, and finally, we reach cash from operating activity. Now, this was the format of cash from operating activity under indirect method. In our next class, we will be discussing cash from investing activity, cash from financing activity, their format, and then we will proceed to the questions. Until then, goodbye and thank you.